the right point in time for us to actually delve into some specific clauses in VC term sheets or shareholder agreements, which have come to be perceived as being barbarian in a recessionary environment. So maybe it's our version of a small rapid fire in that sense. But perhaps what you could do is, for the benefit of our viewers and listeners, explain these concepts in simple terms, and also and your perspective of what is fair and what is harsh, right? So let me start by asking you, liquidation preference, is 1x, is it still going to be the standard in a recessionary environment, or can investors who put in money now ask for more than 1x, and is it fair for them to ask for more than 1x?
I would like to believe, okay, now the concept of 1x and more than 1x is that at the time of an exit, whether one gets to take the minimum of their return or sometimes more than the minimum of their return and things like that. That's the concept of liquidation preference.
Yeah.
I would like to believe that predominantly it will continue to remain at 1x and not go above that. Because I think investors need to be very cognizant that what they write in the rule book today will apply to them tomorrow. Which means if someone's actually going to do a 3x liquidation preference and a $10 million round, and you're going to raise a $30 million round thereafter, the incoming investor is going to take a hard look at the documents and either ask for 3x or bring it down, right? So one has to sort of reflect back to see what precedence one is setting. And the word precedence is very important, because if there is no precedence, which means that if you're pretty much entering a pre-IPO round, or you're pretty much entering a round that's going to lead to an M&A, then you're possibly going to see some of this play out. And you're going to see some of this play out in more of those companies where there's a lot of IP sitting out there, where there is salvageable value. I mean, if you're going to get into a company that at every decision tree has an NPV of 0, potentially, then this makes less sense, right? It is possibly going to also come in situations where valuations that are being paid seemingly look rich, in which case the investor then wants a downside protection by asking for a liquidation. But for these examples that I gave, I would tend to believe that investors will continue to keep their status quo of 1x, because it's important what precedence was set.
Okay. Next one, next concept, and I think this is more prevalent, I would say, in the US VC markets, but there have been times when we've seen these clauses even in India as well. The concept of a participating preference share, and related to that, the concept of double dipping, where not only do I get a preference on liquidation of the company, but I also get to participate in the residual amount along with the other shareholders after I have been paid out my investment in the company. Again, in a normal context, I would say that this would be harsh, but in the current environment, if someone puts in money, would it still be considered harsh?
I'm not going to answer the second part because it's very subjective, but here's what I'm going to tell you.
Okay.
I think we will less likely to see this, because in a lot of the rounds that are now happening, you have multiple investors from previous rounds and investors from current and future rounds. And as a result, people generally want to keep both liquidation preference and anti-dilution less complex, because they want to be more or less aligned for outcomes that they're building for.
Okay.
Lesser the investors, single investor leading rounds or single investor rounds is when you have this complexity of different entry prices, different exit prices, and that divergence being even more. I mean, if you've got 4 investors and they've invested across 3 rounds, and of course there'll be some divergence, but it'll be within means. The other example is when that investors then have very different prices, very different exit motivations, and that's a complexity that I think the world is generally avoiding these days. So I would be surprised to see participating preferred come in. And the only times I would see it is if there's, again, too much risk, too much valuations are out of whack, or the investors coming in is not comfortable, and then he then he's looking for surrogates to protect himself. And then participating preferred or 2x or 3x of liquidation preferences then become avenues. The other theoretical situation where some of this could play out harshly is when, there are a group of 5 investors or 7 investors, and 75% of them are not stepping up to sort of come into a round of financing. Then the ones who are sort of putting the new dollar in are taking asymmetric risk. Then they'll find ways to sort of make it difficult for those who are not coming in and to readjust the risk, which is what I think early on you called for pay to play, and I think some of that happened back in the Uberlime example as well, where some of the early investors had to convert down to significantly lower valuations or convert into common and some of that. I think by and large, investors are cognizant that they need a motivated founder to go build business. So if they are going to sort of carve too much out of the founder's pie, then it's unproductive over time. It may look productive in the short run, but it's very unproductive over time.
So in short, it's not win-win, but it's a win-lose situation, which may lead the founder to a state of disinterest.
Yeah, it's bound to happen. Founders are great, but the pie just keeps shrinking. It just gets hard.
Anti-dilution, explaining the concept. So if the company is raising money at a valuation that is lesser than what the existing investor has invested in, the question therefore is, there are two methods largely that have been seen in the industry to compute anti-dilution protection provisions. One is a full ratchet, where essentially the existing investor is asking for shares to be issued to compensate for the dip in the valuation, and essentially by not paying even a single dollar, that is known as a full ratchet. In the other scenario, it's a broad-based weighted average anti-dilution protection, where there is a downward adjustment, but an average is arrived at, which is then applied for the purposes of valuation of the company and for the number of shares that the investor would be entitled to. So in a tough environment, again, the company is desperate to raise money and does obtain an investor at a lower valuation than an existing investor. Is it fair for the existing investor to ask for a full ratchet, or will that immediately be seen as being barbarian?
Well, I'd like to assume that if it's in the contract, then it's in the contract. And that's the base case. Now, can someone deviate from the base case? I think the answer is yes, but then it's very situational. And it's a very case-specific answer, but I think I haven't seen full ratchet in a while. I think people generally go with broad-based. Particularly what happens in these environments where there are down rounds, I think it's a complex answer. It also depends on who's participating in these rounds. If all the existing investors are participating in the rounds, then it's less complex a situation. But then if you have funds that have ended their fund lives and they're still on the cap table, then that sort of builds in complexity on what happens to them. And is that effectively a pay-to-play round?
Right.
I've generally noticed that what's in the contract gets played out. So it just depends on what's already being built in.
Okay.
But of course, everybody is cognizant that the cap table needs to look healthy, and everybody on the cap table needs to be motivated. So one has to find a buyer media out there. I don't have enough data, quite frankly, on too many down rounds that have happened in the past, at least not in the last 5 years, clearly.
Okay. Yeah.
And one has to sort of situationally play this out depending on what the company is. But I think the headline is what's in the contract to play out. I mean, that's the base case assumption to keep on.
Going back in time, from experience in 2008, were there full ratchet clauses built in at that point in time?
Yeah, I think all the way between 2006 and 2009 or 2010 of deal making, there was a lot more full ratchet than broad-based. I think starting 11 or 12, and of course a lot more of the Western influence sort of hitting us off, I think everybody's sort of now living with broad-based. Either you do too well that you don't worry about these things, or you do too miserably that this doesn't matter anymore.
Well, but this is exactly the time when those provisions may either aid you or come back to haunt you, right? And that's what.
Yeah, so, I agree. I think the base assumption is you should assume what's in the contract plays out.
Okay.
And then see what the delta is from there.
Fair enough. pay-to-play provisions, which basically penalize existing investors if they don't participate in a round. So by either asking for fall-away of their existing rights, some or all of their existing rights, or by actually reducing them to a very, very nominal rights that are given to investors who refuse to participate.
Frankly, in India particularly, I haven't seen a play-to-play round in 13 years in India. I've seen it in other parts of the world. I have seen rounds where larger investors would like to have a more serious role in strategic decision making. And there are times where smaller, very small investors then tend to lose those rights.
Right.
I have seen that happen in India as well. But I haven't seen a situation yet here where, a group of investors have now sort of created a construct where another group of investors pretty much dwindle down to zero. I haven't seen that yet. And if I were to sort of now be very subjective and imaginative on why that's the case, I think a couple of things. One, the number of funds in the investor community is relatively young / small compared to the West, where not everybody knows everybody, not everybody has everybody on their cap table or co-investors, and then you do what's super objective from your vantage point.
Right.
Out here, I've seen most of the top tier funds sort of co-invest with each other, know each other, work with each other, and they have multiple companies going on. So it would be interesting to see if some of this plays out. My guesstimate would be that it would not. I think they will all learn to work together in these times.
Okay. The next concept, fair to look at tranched investment rounds where founders are required to meet certain milestones before they can ask for a certain percentage of the investment that's committed?
I don't think, this is just personally speaking, I don't think tranching is very ideal. You would do tranching because you don't have the liquidity and you think you will call capital over a period of time. That makes sense. But if you believe the founder and the opportunity, then there's very little risk diversification you're going to do by tranching. Because you're signing up for the money, you're anyway signing up for the money. It also adds to complications on valuations and round sizes, and when the next round happens, and when the last round happened, and all of that. And we're not. At Special, we're not a big fan of tranching. If you give it, we give it. Otherwise, we don't give it. It's just simple and easy that way. I haven't actually seen too much tranching happen, at least in the last 5-7 years in our country. What I have seen is rounds being open. Of course, you see large companies, unicorns that sort of raise money over 6-9 months at the same valuation or at about the same valuation. And I think that's the closest to sort of saying that, hey, the round is open. It's not being tranched by the same investor, but different investors are tranching in at different points of time. I think you'll see more of the latter.
And last one, if a company has issued convertible notes, is it fair for an existing investor who's invested through those convertible notes to ask for a higher discount on the valuation that the company is now raising money at?
So I'm a firm believer that what's in the contracts is in the contract. Right? The only time you get to renegotiate contracts is when you're writing in money again. Or when someone else is writing in money again, then they're going to ask for the contract to be rewritten. In between times is a terrible idea to change the contract against the founder. And it's of no sense, there's no outcome, there's no round happening, there's no exit happening. Why would you want to go and trouble the founder? It just doesn't add up. And listen, I think the famous saying goes that if you're an investor, you get to prize when you enter. You don't get to prize other than that. So, you got to be careful when you price a transaction, and you got to be comfortable with it because it's a lot of judgment and art. So, you picked a certain discount, The world has changed.
Let's say an investor wants to invest through a convertible note now. So let's say it's not in the agreement. He's now investing through a convertible note. If the standard is 15% discount, can he now come back and say, I'm investing in a tough environment, give me a higher discount when you raise money next? So let's say make it 20 or 25.
all bets are off, right? The assumptions are fundamentally being looked at all over fresh again by the founder with his customer, by the investor with the founder, by the LP with the investor. So of course, risk reward ratios and sharp ratios and betas have all changed, right? And hence it's very case specific. I wouldn't be surprised if people ask for more discount or more return. And here's the one data I'd like to quote for that, right? And again, I'm just going to go back to quoting what I read recently at CB Insights. CB Insights came up with, Crunchbase came up with something that sort of looked at history of between 2008 and 2012, 14, what happened to valuations, what happened to M&As, what happened to IPOs. It was quite startling to show that it took almost 4-5 years for M&As to come back to the 2007 levels. It took close to 10 years for IPOs to come back to 2007 levels. And across the board, for a good 3-year period, valuations were down 20%. Across the board. If something was worth $2 yesterday, it's possibly worth $1.60 today. That's what data shows. Now, of course, the mechanism at which you price it, and you've got to factor other aspects around it, but that's just plain data speaking. Everything is down 20% minimum across the board.
So you wouldn't say somebody is barbarian because they're asking for a higher discount?
I wouldn't say somebody is barbarian because they're asking for something which sounds high.
Yeah. Okay. No, this is just about also trying to demystify it for founders in terms of how they look at it. Okay?
I think, if I may also add, I think all of this is less relevant and less prevalent in the venture capital environment. You got to understand that barbarians are not small. The barbarians are meant to be humongous, large, powerful people in theory or in literature, right? So if you've got a $50 billion, $100 billion fund and you're a large private equity fund, and then maybe you're likely to look at the NPV of some of these startups that may be close to zero, and then reprice them to your view of the reality, which of course from a chronological perspective may just look harsh, but from at that point of time perspective may not look harsh.
Right.
As they say, beauty is in the eye of the beholder or the vantage point. So what may look barbarian from history may not look barbarian from its present.
Fair enough. Actually, which again brings me to another counter viewpoint. There was another piece that I read recently on TechCrunch, which said how deep terms are changing now. And where, in fact, the exact opposite was actually expressed, where the author tried to caution investors taking advantage of founders who have dwindling options, right? The logic goes that there's obviously a lot more information flow in the startup ecosystem, and that investors equally have to be concerned about their reputations. Therefore, it does not make sense for them to pressurize founders into signing up to some of these terms. My question actually is a little more here. Would investors actually really be concerned about their reputations at this point as much as they are about providing LPs a return on their capital?
So let's assume that if you're given both these options, then you're better off returning money to someone you've taken money from, right? Having said that, let's go back to earlier in this conversation where I highlighted that the relationship between the investor and the founder is a very delicate balance of sharing returns and risk. You do not want to be in a situation where, despite your reality that you have done the right thing, you have a counterparty that is burnt out or feels shortchanged or feels insignificant for the future.
Yeah.
Because then that sort of comes back to you, and what is the end state you want to have as an investor? You want to have a good return. You want to have a good exit. You want to have return money to your LPs. If that is the end state, then you also need to keep in mind that the founder is I wouldn't even use the word integral, I would use the word nucleus of your exit. And hence, if you're going to have someone who's terribly upset, who feels shortchanged and who's making nothing out of this harsh new reality that you've set, then you have a complex problem. You then need to decide if at all you should do such a deal. And if you do such a deal, how do you take care of the nucleus?
Well, let me put a counterpoint to you here. As a lawyer, we are obviously neutral. We don't look at it as only from the lens of an investor or from the lens of the founder. But the point I have here is that venture capital in a way mirrors life at large as well, right? So there are ups and there are downs. And so
Yeah.
obviously, if the founder can come to an investor when the times are good and ask for a high valuation, he must, there's another view that should also be that he should also be prepared for the tough times as well. So why are we mollycoddling founders?
Very, very, very valid point.
Hmm.
I mean, if you were to look at just the facts of the case and on the merits and demerits, I think you're bang on to saying that, hey, if you've enjoyed these rich valuations when the going was good,
Right.
then you've got to take the downside too. I mean, in theory, I agree, right? But like you said, what happens in venture capital is largely what happens in life. So is it with entrepreneurs. What happens in entrepreneurship is also what happens in life. And hence, I may sound philosophical here, but everybody is chasing some sort of happiness here, right? And hence,
Right.
if this environment is going to leave more than half the people sour, then you need to be cognizant of that and find a mechanism to solve for it, or don't put yourself in that situation. There are times, and not to quote anyone in particular, but I've had conversations with founders saying that they will raise a bridge round now. And in the old school, bridge means you're raising a bridge because you have an underlying term sheet or you have an underlying M&A conversation. But then in the new world, you've got bridge that says that you'll aspirationally go and raise funding, which means it's a bridge to what's called nowhere, right? And then I say that, hey, I mean, a bridge to nowhere is a very complex situation because now I have to come and reprice. I have to break open the cap table. Everybody's going to get unhappy. It's just too much bad blood. I mean, if I'm a new investor, particularly speaking for me personally, I'd rather go do something else. I mean, why sort of make half the people on the cap table unhappy and then try and find a solution for it? I mean, especially if I'm not on the cap table already, then I'm a seed fund. I make early investments. I'll do something else. It's important to keep in mind that I'm heavily biased in what I say. It's because that I'm a seed investor. I come in very early. There are times where I've come in even pre-seed. And for us, just from that point of view, the founder is sort of super important in his own state or her own state of affairs and mind and goals and aspirations and what they want to do and whether we think in that journey we make sense or not. And if we don't make sense, there have been enough situations where we said that, hey, you don't need us, forget whether we want to invest or not, and you shouldn't be taking money from us.
Sort of leading to the end of the conversation, how difficult or easy is it for investors to talk to founders and help them rationalize difficult clauses in term sheets or shareholders agreements? I'm not talking about the legal side because clearly that's where we come in. It's just an expression of what the parties want. But I'm talking more philosophically. Is it very difficult to explain to founders a lot of the provisions that we just spoke about right now?
I will answer this just based on my own experience. Right? I think oftentimes I look for end state and I explain the end state that what the founder and I desire and how we want to sort of address each other's risk positions in that. And I think that's a good starting point because then sort of we start with first principles. We don't necessarily start with a rule book contract out there and then sort of saying what's kosher, what's not kosher, what's market, what's not market. I mean, it all depends on what sort of risk appetite both parties have and what risk each one has and how do they solve for it. There's a plethora of information available today than there was 10 years ago, and everybody's reading, everybody's knowledgeable. I think a lot of these terms people understand. What's important to explain is why you want something and what that means for you versus what that means for them. And in all our deals, I think it's somewhere along the life cycle of the transaction that conversation is had. And I feel good when I have those conversations because I feel like I've actually explained why I want what I want and I've heard the other person. And it's just simple that we not only know what each one wants, we also get a better perspective on their vantage point. And sometimes that helps to decipher whether someone's a barbarian or not.
Okay. Brings me to pretty much the last question. What is, if you had to offer suggestions to a first-time founder who's just stepping out to try and raise funding right now, what would your suggestion be to them?
First-time founder trying to raise capital now, it's a tough situation. I have to be very honest. I don't want to sugarcoat it. I think the probability of raising it is dwindling day by day. find a way to stay afloat, find a way to bootstrap, continue to bootstrap. If there are avenues of friends and family capital, explain to them the risks that they're taking and then take the capital from them. I think it's a very tough environment to go out in for first-time founders to raise their first check. I have seen transactions happen, and I hope to continue to happen for good companies. But the base case assumption is it's going to be very hard. Keep a low probability, keep a backup to bootstrap.
Fantastic. Really enjoyed this conversation, Vishesh. Thanks so much for sharing those inputs with our viewers and listeners as well. Yeah, and all the best to Speciale and yourself for the next several months ahead. And look forward to many more interesting conversations with you as well.
Thank you very much. I must say I quite enjoyed the conversations. Your questions did make me think too. And I must say I just spoke what I felt, and I'm glad. I'm glad this is useful to me, you, and hopefully to some of the listeners out there. Thank you very much for this opportunity. Thank you.
Thanks a lot, Vish. Thank you.